actual
like the
test.
depreciation methods one, like I said like depreciation because I forgot what method like meant for a second.
It was like on the first one, like I guessed, but like my guessing is really good. So I just got kind of lucky.
I got the first one wrong. And I was like, okay, I'm good.
Yeah, the first one I was like in between two, but I put the wrong one, and I was like,
Yeah.
oh.
She wasn't worried about it at all. Not the test, but
Yeah. It's whatever. It's
I just read it and I was like really annoyed. I was like,
yeah.
so I was like, oh, I wonder what homework.
That was actually like Edwards at all, and I was
I
like,
know, my
wait.
name's on
I know. That's fine.
All right, good morning, everyone. You had a good weekend? Any golf fans? You guys watch Masters? You?
Yeah.
I watched my share of hours. Okay, Paid Office I, Wednesday. Couple folks from PwC talking about AI at work. It sounds like they're going to be sharing a little bit about what's going on inside of PwC and using it. I think this might be useful for you. Kind of my impression of AI and how it's being rolled out in the commercial space is it's a little misleading. I think news reports and articles that you might read, that everybody's got it figured out, and all of a sudden it's yielding all this efficiency. I definitely think there are growing pains. There are starts and stops that companies are going through where they start something, find out it doesn't work, and they pivot to different things. So I think the good thing for your generation, when you guys enter into the marketplace, you can be part of the solution, helping companies find a path. But it'll be interesting to see what these folks take on what's going on with PwC. Also, I'm sure these people are probably talking to companies as well. So firms such as PwC on the consulting side are also trying to roll out AI and trying to share their expertise with companies that are trying to find their way as well. Okay, final exam. Wake up call first thing, we're 2 weeks from tomorrow. Okay, things moving fast. You guys have that at 8:30, Simon Hall 103, right? Everybody got that? Not here. Yes, sir.
Is the final going to be 3 hours?
It is not going to be 3 hours. You have 3 hours. You don't have to use 3 hours if you do not want to use 3 hours. So, no, great question. My view is I could expand the number of questions to fill up 3 hours, but my experience has been that I don't think it changes your grades anything, because those that do really well continue to do really well in a 3-hour exam versus an hour-and-a-half exam. Those that don't do well aren't going to magically do better in the last hour and a half. So it's like a waste of my time, waste of your time to stretch it out very far. So it'll be similar in length, maybe slightly more than others, but it'll be about an hour and a half, I would suspect. If you have any questions as you're reviewing, please send me a note and we'll knock it out then. My advice, don't over-rely on your one-page notes. Don't think you can write everything down and do well on the exam. It doesn't work that way. Think about the materials. Think about the problems, the examples. Go through them. Do you understand them? Those types of things. The questions will be similar to the examples. Okay. So we're going to finish transfer pricing and then start, hopefully, we will start fast treaties today too. Okay, so I think transfer pricing runs up or slide 12. Okay, so remember transfer pricing, we're trying to price the intercompany transactions, whatever they may be. Remember this example, it could be a multitude of things that go on in a multinational corporation. Don't think it just has to be with the parent company like this example. It could be between affiliates. So affiliates meaning subsidiaries of the same common parent group. What you see is when you map these things out around an organization, is you got arrows going all over the place. Transactions going back and forth, services, sales inventory, IT services, management fees, royalties, interest, all these things going on. So all of those things we gotta get our arms around. Okay? So the bedrock principle we've been talking about is the arm's length standard, okay? That is captured in section 482. 482 is one of those seminal code sections. Everyone knows in the marketplace knows what 482 is. That means you're talking transfer pricing, how we're gonna price this particular transaction or flow of goods. And ultimately, it has to be down, you're held to the arm's length standard. The arm's length standard means a taxpayer should realize an amount of income from related party transactions that it would have realized if the transaction had been conducted with an unrelated party under comparable circumstances. Okay? So even though we fully understand that transactions with related parties are priced differently than we would do with an unrelated party, you're held to the standard of what would you have charged with an unrelated party. Whenever my clients were pushing me on a transfer price, I was not a transfer pricing expert. I just knew how to identify the problem, but we had transfer pricing teams that were available. But I would always say, what would you charge a third party for this transaction? Or what would you pay a third party for this transaction if you're on the payment side? And that is the standard you're held to. Okay? You are inherently better off from terms of perspective of justifying your transfer price as a company because you have all the facts, right? You rarely are going to find a exactly comparable third-party transaction, okay? Because every company can say their product's slightly different, their service is slightly different, whatever they're doing. So the comparable might be helpful and provide guidance, but it's not directly on point, okay? Contrast that with the view of the government, and that could be the U.S. government, it could be a foreign government, it could be state governments. Remember we talked about states. The same issue can happen when you have transactions crossing state borders. You have two different state tax jurisdictions that could be involved. So whomever your auditor is, they are inherently at a disadvantage because they don't have all the facts, right? They do not know your business as well as you do. And so they are always at a disadvantage from an information perspective. But they have two benefits. One, they have the benefit of hindsight. They can look backwards at a transaction. Remember when we talked about the Microsoft transaction and the transfer of IP to their regional headquarters? And the government had the hindsight of looking backwards at the results of that transaction and said, oh my God, are you kidding me? 40-some% of your taxable income for North America resides in Puerto Rico. You have 82 employees and you have tens of thousands of employees in Microsoft, the United States. So they always have that benefit from them is they might not have all the details, but they have the benefit of hindsight. And if numbers skew vastly one way or the other, the government can really benefit from that. The second thing that they have is experience across the country. So they share information, especially the IRS shares information amongst all their audit teams. So if they uncover a transaction that's happening in one part of the country, they could share that information with other IRS examiners across the country so they can see trends. And so they got the benefit of the knowledge of other teams that might be further along in their particular audits than others. Okay, so the arm's length standard, think about how would you deal with a third party under comparable circumstances, everyone having knowledge of the facts. Okay. The principal factors used in assessing the degree of comparability between controlled and uncontrolled transactions. So your controlled transaction is the actual transaction with your related party, right? Because there's an element of control, either ownership or in an individual setting, family relationships, right? There's an element of control. You've heard me say transactions with my daughter. I have an element, hopefully have some element of control over her. So I can have some control over the pricing. Uncontrolled is me and you doing the transaction, right? I cannot control you. If we negotiate the sale of my used car, we're going to negotiate at arm's length, right? So the degree of comparability between the controlled and uncontrolled transactions, factors that are going to be bear upon that is the functions performed. Comparison of the economically significant activities undertaken by the parties to the transaction. So we have to look at who's doing what. You'll hear transfer pricing people talk about the functional analysis. That's what they're doing. When they're interviewing people and they're preparing their defense files, they're largely going to be doing that from a functional analysis perspective. who's doing what, okay? So think in terms of a service transaction. IT services, say that's centralized in the United States and we're charging that out around the world. Well, what are they doing in the United States compared to what they're doing in the other locations that are using the technology? That may or may not be different from a third-party transaction that you might be trying to use or the government might be trying to use where IBM is providing IT services to a customer. So the degree of functionality between the two and what's going on between the parties is important. The risk assumed. Comparison of the significant risk assumed by the parties to the transaction. Think of your supply chain management and optimization planning. If you try to limit the risk of a distributor or limit the risk of a manufacturing entity in your organizational chain, you want to try to limit what they do. So that's going to affect your comparability of third-party transactions because that limited risk might not be exactly the same as in a third-party structure or transaction that you're trying to compare. So you have to make adjustments for those, and that's where the kind of the art of transfer pricing comes in, right? It's more art in that perspective to me is how you move from the controlled transaction from the uncontrolled transaction, to controlled transaction. Where am I going to price that because of differences between risk and functions performed? Contractual terms, examination of the agreement made between the parties. So lots of times, even in related party transaction, we are entering into contracts. So contract for sale, if you're doing a purchase order, that's still a contract in the related party setting. So what are the terms of that contract? Who gets delivery, who's insuring it during movement, who takes title and where, who's in charge of customs and immigration for getting the product into the country. So all of those things may or may not be the same as the third party transaction that you're trying to compare to your transaction. So again, you have to get granular on that. The economic conditions and markets. So right now, we're in a very different economic environment than we were a month and a half ago, right? Price of oil, geopolitical uncertainty. So if you're looking backwards at uncontrolled transactions and then trying to price them today and use them in your uncontrolled or your controlled transactions today, highly different market, right? So you have to take that into account as well, the economic conditions. Nature of the property or services involved. This is the one that's where the company really has the advantage, right? They know their product better than anybody else. They know what they think differentiates them from market transactions and what differentiates them from competitors. So the use of uncontrolled transactions and trying to apply them to controlled transactions might be influenced by the nature of the products and the services involved. As a general matter, when related parties are involved in a transaction, the party performing more significant functions and bearing greater risk should report a larger share of the overall income of the transaction. I think that's intuitive, right? If you are taking on more functions and you are taking on more risk, you need to be compensated more for that. Okay? That's what would happen between third parties, right? The negotiation between the two, the one who's taking on the more responsibilities, the more risk is going to get more, get paid more. Okay? Same thing has to happen in a related party transaction. Very similar to that Microsoft example. The risk and responsibilities of Microsoft Puerto Rico versus the risk and responsibilities of Microsoft US, vastly different. I'm sure that was part of the government's argument. That's why there's too much income being put to Puerto Rico. Okay, so now I want to go through some methods. Might be a little tedious, but I want you to kind of understand what transfer pricing people are doing. Again, this is something that's going to be around for the foreseeable future. There's nothing going to replace transfer pricing. So I want you to kind of think about the methodologies that they're bringing forth, put towards controlled transactions. So let's talk first about transfers of tangible property. So a transfer of tangible property is a very common transaction when evaluating transfer pricing. There are 5 specified transfer pricing methods for estimating the arm's length price for this transfers of tangible properties in the United States. I would say, as a general matter, I would say the U.S. is more advanced in their transfer pricing methodologies and analysis than most other countries in the world. And that's probably because of the history of the US tax code where we were always concerned that multinational corporations were sending too much profit from the United States to foreign subsidiaries like the Microsoft transaction. Remember, pre-Trump 1.0, we would not tax the income that we could house in Microsoft Puerto Rico but for subpart F. That's the only tool the government had, besides transfer pricing. We had subpart F. We didn't have guilty, certainly don't have net CFC testing income. So the U.S. was always trying to use the transfer pricing tools to try to make sure the U.S. was getting the right amount of income. So I put in green here just the ones I want to talk about, so we'll go through each one of those in subsequent slides. We have the comparable uncontrolled price method, resale price method, cost plus method, comparable profits method, and the profit split method. They all kind of sound similar, but there's different ways that transfer pricing people are going at this. The first three are transaction-based methods, focusing on the comparability of products, terms, and economic conditions. We're going to try to price the transaction on a very one-on-one basis, a very ad hoc basis, transaction by transaction. Whereas the profit-based methods are focusing on functions performed and risk assumed. I'm trying to take the entire profit from the supply chain, and then try to carve it up amongst the entities based on risk and responsibilities assumed. Okay. So for the first one, this is called CUP, for the transfer pricing people. And I should say the transfer pricing people, the people who are doing this come from largely come from an economic background. There's a lot of economists that do this because you're analyzing a particular transaction, understanding the functions and the risk and responsibilities of the parties, and then trying to divide up the profit. So it's got a very economic element to it. Now, that doesn't mean in accounting firms you don't have CPAs doing it as well, but you may have some CPAs with maybe an undergrad in economics. But most of the firms do have at some levels and probably in their national office some PhDs from an economic standpoint. So under the CUP method, the arm's length price is the price charged for comparable goods and transactions between unrelated parties. So to me, this is the classical transfer pricing. You want a comparable, uncontrolled price. So it has to be somewhat analogous and it's uncontrolled, meaning the parties are already negotiating at arm's length price. I'm going to take that particular pricing and apply it to my controlled transaction. That's applying the CUP method. Okay. I do need to adjust for any material differences that exist between controlled and uncontrolled transactions. Okay. That goes through all that prior list here, right here, where I might have to make an adjustments on the sliding scale from what the uncontrolled transactions. Okay. It is ordinarily the most reliable method if there are only minor differences between the controlled and the uncontrolled transaction for which the taxpayer can make appropriate adjustments. There is a debate that can occur between the taxpayer and the governments about what is the best method. Okay? Because you can get different answers applying different methods. If the CUP method is sufficiently comparable, the government will argue the CUP method is the most reliable method. Because if I can lift a comparable transaction and apply it with minor differences, that's going to be my best evidence of what is an arm's length price. The most important factor in comparability is similarity. However, assessing the similarity of contractual terms and economic conditions can render the CUP method difficult to apply in practice. That goes back to my point of if I have something, if my uncontrolled transaction that I'm looking at was more than a month and a half ago, and it impacted something with the oil industry, that pricing has drastically changed now. So does that change if I'm trying to price a controlled transaction now because I don't have good comparability for that transaction? So does the CUP method, is it no longer the most reliable method because my economic conditions are vastly different? You might ask, how do I get this information on uncontrolled transactions? There are databases out there that big firms have access to, pay subscriptions to, but where you can query the databases and try to get your comparable data set pulled down. So if you're a retailer and you happen to be doing a buy-sell transaction with a related party, they can pull down retail sales of comparable products. And they'll try to build a range, and that's how they do that. But they build up data sets from that. Now, that doesn't mean the government doesn't always agree with those data sets, because that's part of what can be a dispute, is you have the wrong data sets. Okay, let's do our first example. 12.9 is Mayron.
In this example, US April is a US corporation which owns 100% of Nextstop, which is a Mexican corporation. US April manufactures telecommunications equipment and sells the equipment to an unrelated foreign distributor at a price of $750 per unit. And then US April also sells the same equipment to Nextstop, which then resells the same equipment to an unrelated foreign customers for $850 each. And the condition of USA Coal sales to Nextstop are substantially equivalent to those of the USA Coal sales to the unrelated foreign distributor. And also because this information is available regarding comparable and controllable sales, USA Coal and Nextstop should use the cut method. And using the cut method, the arm's length price is then
So if USACO is already selling to an unrelated foreign distributor at $750, they're going to be really hard pressed to price an intercompany sale of the same product based on the facts to a related party next sub at other than $750. Okay? And if they were, then they have to justify the difference between the pricing. Like, what is different about your controlled transaction from your uncontrolled transaction? Okay. So you'll have to answer that question right off the bat if you're not pricing it at $750. Okay? So what many companies do, in my experience, would price this at $750 because it's just the easiest data for them to get. It's the exact same product, so I know there's no differences there. I'm not looking to somebody else's sale of telecommunications equipment. This is my sale of telecommunications. Okay. Okay. 12.10. One more. John.
So in this example, USACO is manufacturing equipment to sell to a foreign distributor at a price of $750 per unit. And they're also selling the equipment to Nextstop, which resells the goods to unrelated foreign customers for $850 each. But Nextstop only purchases 20 units of equipment, while the unrelated foreign distributor purchases 100 units. So the units Nextstop purchases have the valuable USA co-brand name on it, while the units the unrelated foreign distributor purchases are unbranded. So USA Co provides a 3-year warranty on the equipment sold to Nextstop, but does not provide any warranty on the equipment sold to the unrelated foreign distributor. And any 3 differences, either volume, branding, or warranties, could be a material difference that renders the cut method ineffective.
Yeah, so what they're here is now distinguishing between the 2 transactions, right? Is when I sell to an unrelated distributor that's unbranded, unwarranted, I'm not sure the volume makes that much of a difference. It probably does. You probably give a discount for the higher volume purchases than a smaller volume purchase. But clearly, you should pay $750 if the branded product is worth more in the marketplace, and you're certainly providing a warranty. So that would be worth something. You need to be compensated for that. So if USACO tried to sell this for $750, this is where the U.S. government could come in and say, no, these are not comparable transactions. You need to be compensated more because you are bearing more of the responsibility and more of the risk by virtue of the warranty. Okay. The third method, the second one I want to talk about, is the cost plus method. This is really very, very common. It's very common on intercompany sales of goods. It's very common on service transactions as well. So the type of transaction best suited for this is an intercompany sale of manufactured goods sold to a related party. The arm's length price for the related party is the manufacturing cost incurred by the related manufacturer plus an arm's length markup. These always have a markup, that's the plus. It's your costs that you incur in doing whatever you're doing, and then you make a profit. What is that profit? That's the cost plus method. And you might have to have, again, plus or minus any necessary adjustments from that. Your differences of your controlled transaction relative to the uncontrolled transaction. The markup realized by either an independent manufacturer or related manufacturer on similar uncontrolled products provides an estimate of the appropriate arm's length price. So again, just like I said, we could go out and find the actual sales price. We can find markup percentages for cost plus manufacturers. Those databases exist. The markup is typically stated as a percentage of its manufacturing costs. So you get cost plus 5, cost plus 10, cost plus 20. Depends on what you're doing, right? The more routine you are, the more it's standard knowledge as to what you're doing. You're not adding a lot of value, the less markup you're going to get. The more specialized services, the more bespoke services that you're doing, the more innovative services you're doing, obviously the higher the markup. Okay? We used to always joke, you do get into these jokes with transfer pricing people, it's just a tax humor. They would go through all this effort to prepare this big document, it's always cost plus 5. Like, well, I could have told you that from the beginning, it was cost plus 5. You were calling it cost plus 5. But they had to do all the work to get there. But that's typically on the service side. If someone's doing IT services, how much do they get a markup on that? So you'll hear people call, oh, I bet you come up with cost plus 5. Okay, let's do an example 12 here. This is Mary.
USA Go is a U.S. corporation which owns 100% of Forco, a foreign corporation, and Forco manufactures power tools at a cost of $60 each, and then sells them to USA Go, and then USA Go attaches its trade name to the power tools, which has a significant effect on the resale price, and then we sell them to an unrelated customer in the United States for $100 each. And the independent foreign manufacturing produce similar power tools typically earn a markup on cost of 20%, and under the cost plus method, the ARM index price is $72, which is the $60 just the cost to manufacture the units, and then plus the 20%, the arm's length markup has the cost to manufacture.
So the foreign manufacturing bears cost of 60. They're going to capture 20% of their costs as additional profit, and then that's going to be their share of the overall system-wide profit because there's a sale for 100. So the USA Co is going to pay 72 to Forco. They're going to have a sale when they on-sell it to the customer of 100 and a cost of goods sold of 72. So the US gets 28 and the Forco gets 12 of the system-wide profit, right? Via cost plus. Okay, thank you. So again, it's just how comparable is that 20% that you're borrowing from unrelated manufacturers to your particular transaction? That's what would have to be tested. Okay, the last one on transfers is tangible properties, the profit split method. And it evaluates whether the allocation of the combined operating profit attributable to an intercompany transaction is at arm's length by reference to the relative value of each party's contribution to the combined profit. Okay? So instead of fixing what we just did with Mary, we fix the profit of the foreign subsidiary, everything else falls to the US. We're going to take that full 40 of system-wide profit and try to parse it out amongst the entities based on their relative contribution to the combined profit. Okay. 1215 is fun.
Forco, a foreign corporation, manufactures liquid soap using its proprietary manufacturing intangibles that have a fair market value of $3 million. Forco sells the liquid soap to its US sub, which, due to an extensive advertising campaign, owns marketing intangibles with a fair market value of $1 million.
Let me pause you there. So marketing intangibles, right, is usually who's bearing the cost of developing the brand from a market standpoint, right? So US Sub is bearing that cost, right? So they're going out, doing the strategy, paying, you know, whatever they're doing on social media, they're doing it linear television, whatever they're doing, but they're doing all that print ads, whatever. They're incurring all that cost developing that strategy, therefore they own the marketing. Okay. That could have been done factually from Forco. It's just not the facts in this example, right? But it's just who, you have to examine who's actually doing that work. Okay.
Accordingly, Foco owns 75% of the group's intangibles, and US Sub owns 25% of the group's intangibles.
So that's over here. The marketing intangibles is the 3 million, right, that Forco's doing, and US Sub, sorry, said that wrong. Forco has manufacturing intangibles of 3 million, and marketing intangibles, US Sub is doing all that work, paying all those costs, has 1 million, so that's 75, 25. Okay.
Before paying Foco, US Sub earns a return on sales of 20%.
Okay.
An economist determines that a routine manufacturer, that is, without any manufacturing intangibles, will earn a return on sales of 7%, and that a routine distributor, without any marketing intangibles, will earn a return on sales of 5%. After allocating these routine returns, that's total 12% to each party. The residual of 8%, that is 20% less 12%, is split based on the relative value of the intangibles with 6%, that is 75% of the 8%, going to Forco, and 2%, that is 25% of the 8% going to US Sub. Therefore, US Sub must pay Forco an amount that will allow US Sub to earn a return on sales of 7%. That is 5% of routine distribution functions and 2% for its marketing intangibles.
So just to unpack that a little more, so the transfer pricing / economists would come in and say, okay, the manufacturers for Forco, if it were a routine manufacturer, would get a return of 7% on the transaction, and the routine distributor would get 5%. So first we're going to compensate them for the routine. And routine means you're just doing, there's nothing special about what you're doing. This is liquid soap. You're just making liquid soap and you're just selling liquid soap, okay? And then we go in and say, okay, there's still profit on this because I got a group-wide profit of 20%. Okay? I've compensated 7 to the routine manufacturer, compensated routine distributor for 5. How do I split the residual 8%? And that's the 75-25% based on the manufacturing intangible ownership and the marketing intangible ownership. Okay? That makes sense? So we're looking at this thing in total, compensate everybody for their routine activities, and then look and see who has the intangibles, and then we split the residual profit based on that. Right amount. And what that ultimately does, the punchline is at the end, is saying how much US Sub must pay Forco for an amount that will allow US Sub to earn 7%. Right? So we got to back into the transfer price to get everybody the right profit. That's the profit split. This is, my experience has been US companies do not like the profit split method because a lot of intangibles are owned in the United States. They've been developed in the United States over time. Think about the consumer product companies like this, like liquid soap and toothpaste and all that stuff. All those brands are owned in the United States, right? They've been developed over decades in the United States. So heavy intangible would pull a lot of that profit back to the United States. Okay, so now let's look at transfers of intangible property, right? So we could have transfers of, this could be licensing or this could be outright sales of intangible property. But a transfer of intangible property between related parties is another type of transaction we need to consider transfer pricing. There are 3 specified methods for transfer pricing for estimating the arm's length price for the transfer of the intangible. We're going to cover 2, have the same title as we have before, they're applied slightly different given the products. So the cut method is still applied in the profit split method, and we're still looking at it on a transaction basis versus a system-wide profit basis and trying to split up the profits between the two. Okay, so the cut method, not the cut method, it's the cut method. So comparable uncontrolled transaction method for transfers of tangible property is analogous to the cut method for transfers of tangible property. Under the cut method, the arm's length price is the price charged for transfers of comparable intangible property between unrelated parties. You still have to adjust for material differences that exist between controlled and uncontrolled transactions. So the difference here is there can be much more variability because intangible property is, in my experience, typically harder to value, and there's more distinctions between what a party has versus a tangible product, right? Unless you have a product that is just brand new, innovative, that doesn't have a true comparability, there are lots of similar type products. We all know that when we go out shopping and we look at things, we can compare and contrast product. Intangible property is just inherently company specific. It can be much more difficult to try to find a comparable transaction. So in order for that uncontrolled transaction to be considered comparable to the intangible involved in the controlled transaction, both intangibles must be used in connection with comparable products or processes within the same general industry market and must have comparable profit percentage. That's what makes it inherently difficult. Is it related to the same product, same general industry and market, and have comparable profit potential? 1218. This is
USA Co., a U.S. corporation, is a pharmaceutical company that develops a new drug.
So just think about that. Pharmaceutical company developing a new drug. What's your comparables out there on that? That's going to be much harder to find, right? Because you're not going to do the exact same drug as somebody else, right? You want to try to have some kind of difference. Even like if you do the GLP-1 drug, the companies say there's slight differences between them, right? They're trying to develop their little niche market there. Okay.
USA Co. licenses the formula to an unrelated pharmaceutical company in California for a royalty of 10% of sales. USA Co. also licenses the formula to its Canadian production and marketing subsidiary, CanSub. If all the comparability factors between the two licenses are identical, CanSub should pay USA Co. a royalty of 10% of sales under the cut method. However, if the two licenses are not comparable in a manner for which the parties cannot make reasonably ascertainable adjustments, the 10% of sales royalty is not a comparable uncontrolled transaction.
So what the economist would have to look at is, what is the license? The license with the California unrelated company versus the license to the Canadian sub. Who is doing what type of product is it, and then how is it being used with the risks and responsibilities amongst the parties? If it gets too far askew, that's going to throw the uncontrolled transaction out as not being comparable. I'm just posing to you that it's much harder to do with intangible products such as this compared to the tangible liquid soap or something like that we can readily value. Okay, the profit split method. Under the profit split method, related parties can allocate their combined operating profit for transfers of intangible property by how unrelated parties engage in similar activities under similar circumstances allocate their combined profit. So this is going to be similar to the rationale that we did with Claude's example. So 1221 is Sean.
Cola, a foreign corporation, has its research and development lab create its cola syrup, and Cola licensed the syrup to its US sub for bottling and sale in the United States, and the formula has a fair market value of $3 million, and due to an extensive advertising campaign, US sub owns marketing intangibles with a fair market value of $1 million. So Cola owns 75% of the group's intangibles, US sub owns 25% of the group. And before paying Cola, US sub earns a return on sales of 20%. So an economist determines that a routine R&D lab without any product intangibles would earn a return on sales of 7%, and that a routine bottler without any marketing intangibles would earn a return of sales of 5%. After allocating these routine returns, totaling 12% to each party from 20%, the residual of 8% is split based on the relative value of the intangibles, with 6% going to Forcola and 2% going to US Sub. So US Sub must pay Forcola an amount so that US Sub earns a return of sales of 7%.
So this is very similar to Claude's example. We're first going to compensate each party as if they were a routine manufacturer or a routine bottler, routine R&D shop and a routine bottler. Once we cover that, then we have the, is there any profit left over? Yes, and then we allocate that to each party based on their ownership of the relative intangibles that are involved in the product. Okay, so very similar to tangible property. But we're looking again at system-wide profit when we allocate that. Okay, thank you. Okay, so we would do all that work. We would apply the different methodologies, pick the best method for each particular transaction. That one example that I started, we ended last class with, it showed all the different transactions. You just see the myriad number of transactions that have to be covered, right, in a global business. So your required documentation that you have to have, it needs to be contemporaneous. Contemporaneous means that the documentation must be in place when the taxpayer timely files his tax return. Okay? The reason we have a contemporaneous requirement is the government does not want taxpayers to set their intercompany pricing and then wait for 2 years and then a tax authority somewhere in the world or somewhere in the United States complain about the transfer price and then you do your documentation. Why? Because they think you're just going to do the documentation to support the number, right? Because you already filed your tax return. So you're going to let the tail wag the dog and you're going to say, oh, I got to get to that number, so my documentation is going to flip to that number. Okay? Whereas if you do it contemporaneous, so it has to be in hand, in place, when you file the tax return, the idea is you're going to get to a better comparability price, and then you file your tax return accordingly. So do the work, put the number on the tax return. That's the idea. If your documentation is not contemporaneous, then the governments can potentially not look at it. Okay? So what does that documentation look like? What does it include? It includes an overview of the business, a description of the organizational structure, a description of all related party transactions, a functional analysis describing the functions performed, risk assumed, and resources deployed. So looking at the transaction flow, writing all that up, a description of the transfer pricing method selected and why it constituted the best method. So of those that we talked about, why'd you pick that one? Why is that the best one? A description of the comparables used. That's your data set. Why are these the best examples that you want to use as your uncontrolled transactions and apply them to your controlled transaction? And then an explanation of the economic analysis and projections relied on. So this is the transfer pricing documentation. These things can be pretty thick, right? And you don't just do them and set them aside because as business changes, then you have to update your transfer pricing documentation as well. Usually what you have is there is a group within a large organization that is just doing this. It's a transfer pricing team, and there might be 2 or 3 people doing this, but this is a full-time job, keeping all this documentation. Sometimes you'll hear them say they have a master file. What they're saying there is they've captured some of this top part in a master file, right? Because the description of the business, the organizational structure, that's kind of there, right? That applies to everything. So I could borrow that for all my local country transfer pricing documentation. But when I get specific into the transaction flows, then I have to go in and do that on an ad hoc basis. The information gathering is usually the most time-consuming aspect of preparing transfer pricing documentation. You have to go out and talk to the business people. You can't do this like in your cubicle. You have to go out and talk to the operations people. You have to find out if you're doing profit split. You got to find out those intangibles. Who's paying what, who's doing what. So it's a transfer pricing person really gets to know the business. That's why you see the economists come in there, is because they can really understand who's doing what and functions being performed relative to each other. So that is a very time-consuming process. You need to identify all related party transactions, which could be thousands for large multinational corporation. You'll need to likely interview those operating personnel. They may or may not be ready or exactly excited to talk to transfer pricing because they got their own thing to do, right? They're trying to do their job and they'd be like, oh, you're just asking me this stuff and it's an internal transaction. Who cares? It's all eliminated in consolidation. Why does it matter? Legal entities and jurisdictions matter from a tax perspective, right? They don't care that it's one large organization. There's different countries involved, right? Remember, all the way back to day one, we're thinking about the pie. Each jurisdiction trying to get a piece of their pie, right? So that's what you're trying to comply with. And you need to obtain relevant financial information, including internal cost accounting, profit margin analysis for the transactions at issue. The other thing that this can bear upon is if you're adjusting transfer pricing within internal transactions, that doesn't affect the global financial statements, but for your tax expense that you're allocating, that result from your allocation of the profits. But largely the intercompany price is ignored, right? It gets eliminated in consolidation. What it doesn't get eliminated from is managerial accounting, which might impact performance metrics and bonus metrics. So you got to be careful for that as well. You're adjusting an internal price, and one of the business leaders you're talking to, that they're on the other end of that transaction where the profits are less than when you started, that could be a problem as well. So you kind of confront reluctance to give granular entity by entity, jurisdiction by jurisdiction information, and then how does that impact non-GAAP financials for performance evaluations. So there are information reporting requirements. We have a form 5471. We don't do forms in our tax courses, but form 5471 is applicable to U.S.-owned foreign subsidiaries and includes the dollar amount of related party transactions. So we have a U.S. parent, you got a foreign subsidiary, you file a 5471 that reports information about that foreign subsidiary. One of the things you have to capture is the related party transactions amongst the parent and that subsidiary. So that's where the U.S. government can have visibility into those internal transactions. Like, oh, I see you have a massive amount of intercompany inventory flows. How do you price those? That's how the questions start. Right? Oh, I see you license intangible product to your foreign subsidiary in exchange for a royalty. How did you price that royalty? That's where the company would say, here's my transfer pricing report. Have at it. Okay. Form 5472 is the flip side of the 5471. That's when I have an inbound investment, so I have foreign parent investing into the United States. The United States wants to understand transactions between the two parties as well. And that's going to include reporting of transactions with the foreign related parties. So 5472 is on the inbound side, 5471 is on the outbound side. But it captures intercompany transactions again, so the U.S. government will see it. Books and records, the IRS can ask to see books and records sufficient to establish the correctness of reporting intercompany transactions. They have the right to request additional information. That's typically what happens in an audit. There's lots of information requests back and forth. Companies usually have a person or two that directly are responsible for interacting with the Internal Revenue Service and trying to feed them information. And that can be a very difficult thing to do because you're trying to balance a lot of competing demands and time constraints and talking to people and extracting information from large organizations that isn't as readily at hand as you would think. Jurisdictional and legal entity based. Country by country, called C by C, by many people, is an OECD-led initiative, and the reporting includes disclosure of financial information of related companies, functions, and numbers of employees. So these are reports that the rest of the world wants to see, and it's basically showing me by country, how much revenue and income are you reporting in that country, how many employees do you have in that country, how many, what's the volume of assets you have in that country. What they're trying to look for is disconnect between the amount of profits reported someplace and the level of activity in that location. So that Microsoft Puerto Rico example would have stuck out like a sore thumb. We didn't have country by country reporting back in those days that were audited, but you do now. So if you try to locate a bunch of income in a low tax country and you don't have a lot of assets and people involved there, then other countries in the structure can then start asking questions. Right? It's a sunshine perspective. Show me your facts so I can take a look at them and see what. Okay, we have penalties for not being compliant with the arm's length standard. And these are to encourage voluntary compliance with U.S. transfer pricing rules. So you may be subject to a transactional and a net adjustment penalty in cases of non-compliance. So the transactional penalty applies to a substantial valuation misstatement. So the government is not going to quibble with you if you charge an intercompany royalty and you charge it at 5% and the arm's length price should be 5.1%. Okay? We're talking substantial misstatement. So the government is looking for something that is materially incorrect relative to the arm's length standard. So this only applies to a substantial valuation misstatement, which generally occurs when the price charged in the controlled transaction is 200% or more or 50% or less of the arm's length price. So if you have an adjustment, the government proposes an adjustment, you go through the appeals process, you lose, or if you go to court and you lose, and the adjustment is materially different from what the price you put on your tax return, you can get hit with the transactional penalty. That's looking at the transfer price and how much what you put on the tax return deviates from what the ultimate resolution of the transfer pricing dispute is. Secondarily, you can have a net adjustment penalty. Now, this doesn't focus on the transfer price, it focuses on the resulting impact to taxable income. So, when the net increase in taxable income resulting from transfer pricing adjustments exceeds the lesser of $5 million or 10% of the taxpayer's gross receipts, so again, material adjustments, but we're looking to how does it affect the amount of tax you owe? If it's lesser of 5 million or 10 million of taxpayers' gross receipts and you exceed that threshold, then you can get hit with a net adjustment penalty. These penalties are 20% of the underpayment of tax attributable to the misstatement. However, if the misstatement is gross, meaning it is egregious, the reported amount is 400% or more or 25% or less of the arm's length amount, the penalty increases to 40%. Okay. These are sticks that the government is using to make you comply. So, yes, it's hard for me to, from the perspective of the government, as the government, the IRS that enforces the Internal Revenue Code, hard for me to see these transactions, evaluate these transactions, second guess these transactions and propose adjustments. Therefore, I want you doing the work. Okay? The other way this is enforced as well, right? This impacts your tax and whether you're subject to a penalty or not. This is one of the functions of the way the U.S. system works. If you're a publicly traded company, who else is looking at these numbers? Your audit firm, right? And your audit firm is going to have transfer pricing experts. They get brought into the audit team. They evaluate your transfer pricing. They will evaluate it in light of these penalties as well. So they can ask questions just like the Internal Revenue Service can, because as part of their job, they need to assess whether the transfer pricing is reasonable. Right? That's the overall standard for them signing their audit report on the financial statement. And so they will evaluate just like all those methods we talked about, everything else the IRS would do. And I would argue they may be the best position to ask those questions. Especially if you got a big four audit firm, they're going to have some very, very smart transfer pricing people. They're going to have some national transfer pricing people. Again, lots of experience, lots of know-how about what's going on around the country. So I almost think of, not dissimilar to any other tax issue, the first line of defense is if you're a publicly traded company, you've got to get this through your audit firm. They're going to bring their tax expertise to the table on that audit. And so you can think of it as, is it almost like an outsourcing of the tax audit function? Because if a Big Four audit firm has agreed with your transfer pricing, what's the chances are of the IRS being able to sustain a change in that transfer pricing? Now, assuming Microsoft got their audit firm to sign off on those years at issue we were talking about with the Puerto Rican transaction, and now the government's still taking issue with that, but we'll have to see what that is. But I always view that as the first kind of outsourcing line of defense, is that financial statement audit function that's going to take a look at these things as well. Okay, this is not from the book, but sorry, it is from the book, but it's not labeled. I kept it from prior editions. So let's just look at the penalty situation here. So USA Co. manufactures auto parts and sells them to Forco. We got an outbound situation for resale into its market. The transfer price utilized by the companies is $30 per part. Upon audit by the IRS, the arm's length price is adjusted to $100 per part. And assuming that that was disputed or appealed or whatever, but that's the final number, right? The company accepts that it's $100. The result is a substantial valuation misstatement, as the transfer price used by USA Co. of 30 is less than 50% of the 100. So you were lower than 50% of the price that was used. So the result, assuming the adjustment results in $1 million of additional U.S. taxable income, the penalty would be $200,000. If the transfer price used by USA Co. and Forco were instead $20, so below that number, the adjustment to 100 would constitute a gross misstatement, because 20% is less than 25% of the $100 arm's length price, and the penalty increases to 40%. Okay, so think of this as a pretty heavy stick. If you have a transfer price that was $30 and the government was successful in moving it to 100, depending on the materiality of that overall to your taxable income position, that's a material adjustment, right? That's going to be a penalty situation. Penalties are automatically applied if the numerical thresholds are exceeded. However, the taxpayer can argue that they have had reasonable cause and acted in good faith. So you could try to rebut the assertion of a penalty, but the transfer pricing penalties are automatic if you exceed the thresholds. They will be assessed, and you have to plead for forgiveness based on your reasonable cause and good faith. Okay? So you need to develop a transfer pricing strategy. The best thing you can do is compile a defense file. You know what they're going to look at. You know the questions they're going to be asked. So do your work before. So a formal transfer pricing study, which that can be done externally. Accounting firms have a whole service offering on transfer pricing studies that they will help you build these files, and they'll do it for bespoke transactions. They'll do it for your entire portfolio of intercompany transactions. So need. Some larger companies, again, do this stuff in-house. It doesn't matter if it's external or internal. Transfer pricing study has to be done, and it establishes defensible transfer pricing positions and argues against and audit adjustments in any imposition. That's your best. When someone asks, say, I want to question this transfer pricing, if you can give them a meaty piece of documentation, 100 pages, something like that. I always say it's the weight test, right? The auditor, again, not having those level of facts is inherently behind the 8 ball, right? And it's hard for them to challenge that type of analysis. The supporting document needs to be contemporaneous, in existence at the time the tax returns are filed. You can't do this to fill in paper around the number you already put in. The government wants you to do the analysis before you put the number on the tax return. You could enter into an advanced pricing agreement. Okay, so this has come to bear in the last few decades. Global organization, they have two things, right? They're interested in paying the least amount of tax legally due in all the jurisdictions in which they're doing business, but they also create certainty, right? And if I have transfer pricing disputes spiking all over the world, and I have this portfolio of disputes that have to be managed, that is very time consuming to the business. Right, just trying to, this ongoing disputes. So sometimes they say, let's just agree what the transfer pricing is before we file tax returns. Save me a lot of time and headaches of defending this, save you a lot of time and headaches in government in arguing these cases. Why can't I come in and say, here's what I'm going to do? Any of those examples we just went through. Here's what I'm going to do. Those are my facts. Here's my analysis. What questions do you have? Field your questions, respond to those. We're done with it. Let's sign an agreement that these are the transfer prices. And I'm going to have a term on this agreement for how many years. If my facts haven't changed, we're going to agree these are the transfer prices. That's an advanced pricing arrangement, APA. So, an advanced pricing agreement can be unilateral, which you have two countries, right? The transfer price has to cross a border for anyone to care. If it's all within the United States, the federal government doesn't care, right? It doesn't matter. It all goes into taxable income. Now, the states might matter if it crosses the borders of a state. But what if I have a transaction that's just in Missouri, just in the United States? There's no transfer pricing dispute there because there's no chance of taxable income being skewed. But once it crosses a border, a state or a country border, then I could have a bilateral APA, which means I get both countries involved at the front end, and we have discussions about here's my transaction flows, and I want to get prior agreement to these things. That provides the certainty. No more disputes about that because you cannot argue about that, and you have to file your tax returns in accordance with those pricings. I can't have a unilateral APA where I don't involve the other country. So if I'm worried about the IRS, I could just interact with the IRS, set the transfer pricing, agree. The US won't make an adjustment, but that doesn't mean the other country is going to necessarily agree. Now, that might be persuasive to the other countries that the US has agreed to it, and there's been some additional documentation out there, but it doesn't mean you have to. So these are not easy things to do. Okay? It's easy to say, oh, let's just sit down with two countries and have a discussion about a trend. These are very time-consuming things in the front end as well. So these are high volume flows, high dollar flows that are going to be ongoing for a number of years. And so APA agreements are not uncommon. And they are for prospective years. Again, I'm trying to prevent disputes in the future. And if I apply the agreed upon methodology from the APA, the IRS will not adjust my transfer pricing in future audits. And the governments come out with their stats on APAs as to where they are in the process, how many new cases have been requested, where are the ones in the ongoing process, and how many have been concluded. So it's one of those things where all parties can win because we get certainty on these things and we can stop disputes, but they're just extremely time consuming. People change roles, right? So whoever was working on it in the government, if there's a change in the government, then they're not working there anymore, so it can be very, very difficult just to keep these things grinding along. But you will hear large multinationals in there. Okay, so I wanted to demystify what transfer pricing really is. It's the arm's length standard. The devil's in the details of getting that supported. It's easy to say, it's hard to do. Building that defense file, being prepared for discussions with your financial statement auditor and then your governmental auditor, and how you deal with those potential assertions of penalties and development strategy. Okay, I want to start chapter 13 today. This is our topic that is common for both inbound and outbound, and this is tax treaties. So tax treaties, again, are contracts between countries. Just like you've heard treaties that end wars, those are contracts between countries agreeing on the terms. These are the same types of agreements, they're just dealing with financial matters, taxing matters, okay? The United States has a model treaty. Okay, the model treaty means it's like, think of it as like a template. When they open treaty discussions, we don't start like, oh, let's see how we draft this thing. We have a set document. Put it on the table and it's like, let's start with this. What things do you want in there? What things do you not want in there? What do you want to adjust? What do we want to negotiate? And it becomes a negotiation between the parties because you also want certain things involved in the tax treaty. The other country might have certain things in their country. And again, these are time-consuming projects. These don't happen overnight. Negotiating a tax treaty can take a number of years. And again, you have changes in government. Some governments are more excited about these kind of bilateral agreements. I would suspect that the Trump administration maybe is not as excited about these bilateral agreements and puts less emphasis in this area. But nonetheless, these are really important because it provides certainty, it helps mitigate disputes. So multinational corporations really seek to have tax treaties. So we're going to talk about the U.S. model treaty. We can't talk about each individual country's treaty. It's just the volume of them is too much because it's not just the United States. There's treaties between, I'm just making this up, I'm sure there's a treaty between Canada and the UK. I don't know what those terms are. Right? We have too many variables to start talking about individual countries. So we're going to focus on the model treaty. And it'll give you a flavor. What I want to share with you is just the flow of the document, what topics are covered, how to read them, how to approach them, and go from there. So we're going to have core operational articles. And I put in the parentheticals the article number from the treaty. And think of the article number is like the paragraph. It's in, there might be multiple paragraphs, but I like to think of them as a section in the model treaty. So we have definition of a resident. That's kind of the threshold question. Are you a resident of the country trying to apply this treaty? That's really important because if you're not a resident of that country, you can't apply that treaty. You're not entitled to apply that treaty. So the threshold question is making sure that your party and the other party you're dealing with are residents of those two countries because then they can invoke the treaty. Okay? Definition of permanent establishment, that's that threshold at which you become a taxpayer in a particular country. Remember, that's the bricks and mortar kind of permanent features. It's boots on the ground, people in the country. So those thresholds are going to be covered in the PE article in Article 5. Business profits, Article 7, that's how much of your income, what are the framework of how much we're going to attribute your income to your permanent establishment and subject to tax there. Personal services income, this is the degree of time and activity that an individual can do in a country before they become subject to tax in that country on an individual basis. We've talked about withholding taxes many times. I want to show you what those provisions look like. And we're going to go through the common ones of dividends, interest, royalties. What is the withholding tax rate? Remember, the United States starts off, if you're not in a treaty, it's 30% if it's coming from U.S. sources. These provisions typically lower the 30% to a number materially lower than 30%. Gains from the disposition of property, personal property, and then we're going to have income from real property, which is real estate and transactions. We have another group of provisions that deal with relief and anti-abuse provisions. We're going to have an Article 23, which is relief from double taxation. Right? One of the things that treaties try to do is the treaty partners, the partner countries, understand that taxing the same item of income twice is detrimental to business. We're trying to mitigate that. That's going to be covered there in the relief of double taxation. And we're going to spend some time on the limitation on benefits and the anti-treaty shopping. This is Article 22. This is probably the biggest issue in treaties right now is if you are in a non-treaty country, you're going to try to invest directly into, say, the United States, since we're dealing with the U.S. model treaty. Then you know you got 30% withholding coming out of the United States on your earnings, and you're probably going to have other unfavorable like triggering standards for when you become subject to US tax, other than the permanent establishment article, because you're not in the treaty. You're not entitled to the treaty. So what the limitation on benefits / anti-treaty shopping rules are trying to say is, we know those parties might try to invest in the United States through an intermediary jurisdiction that does have a treaty with the United States. Think of treaty shopping as, oh, I can't get a treaty directly with you, but I can go through another country into the United States and impose that intermediary and avail of a treaty. The US is wise to that. The rest of the world is wise to this. I'm going to go through a pretty important court case that came out of India. That India applied this. They just this court case came down in January of this year, where they limited the application of the tax treaty between India and Mauritius. And so, lots of anti-abuse rules to try to prevent the inappropriate use of treaty jurisdiction when you otherwise could not do so. The other thing that's dealt with in treaties is disputes and transparency. So disputes. There, even with a treaty country, there could be a dispute as to the proper amount of withholding tax. Okay? And how do you resolve that dispute? Tax treaties have an article that actually provides some structure as to how that dispute gets resolved. If not, these things can go on an inordinate amount of years. So companies, they like treaties because they provide certainty. One of the things they like certainty is, we realize that there can be disputes, but how do we get to the finish line? How do we finish this so that there is an end in sight? I can't be disputing this 5-10 years from now. Okay? So that's covered in, and we'll go through that article, Article 25. On the other side of that is transparency. So Article 26, the exchange of information. What the countries then decide to do is like, okay, we will agree to resolve disputes with transfer pricing for the company's sake, but we also want to share information amongst ourselves about what the company is doing. So if there's all those examples we just went through, there were 2 countries involved. If one of those countries is auditing that particular transaction and they need information on the other side of the transaction, if it's a treaty partner, they can invoke the exchange of information provisions of the treaty, where the other side, the other country, will provide information on the other side of the transaction. What's happening in your country? Functions, risks, responsibilities relative to my country, so I can build my case. Again, because I'm behind the 8 ball in trying to understand the transaction. Companies have an inherent advantage in that perspective. So the jurisdictions protect themselves with this exchange of information. So obviously that's important for multinationals as well. It's like, well, what information are you sharing? Because I want to kind of be involved in that. And so that's an interesting debate. Okay. So tax treaties mitigate exposure to double taxation and cross-border transactions through tax reductions or exemptions on certain types of income derived by residents of one country from sources within the other treaty. Treaties often substantially modify U.S. and foreign tax consequences, necessitating taxpayer consideration of the relevant treaty provisions to fully analyze the income tax consideration. So you cannot be, if you practice international tax, you cannot just be an expert on the U.S. rules on international tax. You have to consult the treaty in cases where the other side of the transaction is a treaty partner, because that can modify the U.S. results. You have to understand that. Simplest example is, if you just read the U.S. statute, withholding's 30%. But you don't withhold at 30% if you're paying to a treaty partner and they're entitled to the treaty and the treaty says 5. Right? You won't get the transaction correct unless you also consult the treaty. So you have to understand how these documents flow and you get to the right place before you analyze the income tax. Just note that in addition to income tax treaties, the U.S. oftentimes enters into other treaties with foreign countries governing Social Security taxes, estate and gift taxes, and international shipping and aircraft. So if you're searching for a tax treaty, just be careful, sometimes it might pop up and it's something different than income taxes, okay? Like Social Security. If someone has been paying into the US Social Security system and then they go work in France for a while and they're subject to the French Social Security system, the interaction of those two provisions would be in the Social Security agreement, if there is one, in my hypothetical, between the US and France. So just be careful as to where you're finding the right document that you're looking at. There are other tax treaties that deal with different types of taxes rather than income taxes. So we are only going to deal with the ones on income tax. Okay. The U.S. currently has tax treaties with approximately 69 countries, including most of our major trading partners. Why? Because of the volume of transactions. The volume of transactions, that's going to have companies on both sides of that saying, hey, we need to get a treaty in place here. That's why over the decades, you got up to 69 tax treaties. And so you just look through here and it's going to be all the usual suspects you would think. We got all the Western European countries. We have lots of the Asia Pac. We got China. We got Hong Kong is not included. So the United States treats Hong Kong separate from China from a treaty perspective. And see if there's any other ones that are interesting here. We obviously got the UK, we have Mexico in here, we have Canada, obviously. So pretty exhaustive list. The ones we do not have Brazil. Brazil's a major economy, largest economy in South America. Lots of transactions involving the US. The reason they're just is the discussions have never gotten off the ground with Brazil, no matter what multinationals want, because Brazil just has some interesting, they're centralized around transfer pricing rules that the U.S. just does not agree with. They do not think that they apply the appropriate arm's length standards, and therefore, if we don't have some level of agreement on how taxes should work, it's really hard to even launch a tax treaty discussion with a country. So Brazil is probably the biggest gap. Some of these are very old because once a tax treaty is signed, it's enforced, right? You'll see at the end of it, it'll say this is enforced until one country agrees to withdraw from the agreement. So as long as they're in place, they're in place. So these things could be decades old, right? And so sometimes you'll see, well, let's update because the world has changed since the last time we did it, right? We're more high tech. It's business is just different than it was decades ago. So you might see different countries at different points in time want to refresh the treaty. Again, that's an easy thing to say, hard to do. But you might be at different stages where a treaty might be updated. Okay, so we're going to use the U.S. Model Income Tax Convention. When you hear the word convention and treaty, they're the same thing. In my mind, they're just the agreements between countries. And the latest one we had from updating the treaty, from the model treaty on the U.S. perspective, is 2016. And it is our baseline negotiation position for establishing tax treaties with other countries. It's like our first offer. Okay, let's start with this draft document first. Okay. However, the U.S. Treasury Department, which is the executive agency tasked with tax treaty negotiation, separately negotiates each tax treaty as a unique document. Right? So we might start off with the template, but as it gets refined and negotiated, it gets signed by the two countries. That is its own document, right? Separate and apart from the model treaty. The model treaty reflects a general pattern of most tax treaties. It is a useful reference point for our coverage of common treaty provisions. You still need to review the exact terms of the specific tax treaty in place between relevant countries if you're evaluating a transaction or an issue. Okay? So, in practice, you're not going to look at the model treaty because the model treaty has no effect anymore, right? It's the template. So if you've got an issue with the U.S. and Canada, you can pull up the U.S. and Canadian tax treaty, make sure you have the latest one, make sure it's the income tax treaty, get to the right article. That's going to be your analysis. The U.S. Treasury Department typically issues a technical explanation for each tax treaty that provides a bit more detail than the text of the specific tax treaty provision. Be careful with those, they do give you a little more explanation, but they are not part of the treaty. Okay? So it's useful if you're having a debate with the US government about that.